Trading breakouts can be a really profitable way of taking advantage of market momentum, but it's not without its drawbacks. In this video, I'll go through some of the do's and the don'ts. Hello, I'm David Jones from Capital.com. I thought we'd do a video on trading strategies. I'm a big fan of trading breakouts. We're going to cover some tips for trading them in this video, but first of all, we'll take a look at what I'm actually talking about when it comes to breakouts. As usual, if you're watching this and you haven't subscribed, if you can click on subscribe, support the channel, and we'll continue to push out hopefully lots of interesting content in the months ahead. So when we're talking about breakouts, this is the sort of thing we mean. This is the gold chart. So we've got a high in 2016 around about 1380, and you can see all the way through 2018, early 2018, the market can't break it. Then jump forward, May 2019, we're back up here again, sellers coming in, but then this happens. So the price breaks out, it breaks through a previous level, either breaking up or breaking down, and it can be the sign of a new trend starting. And of course, eventually that did end up being the case in gold. It broke through 1380 in June 2019, and it's currently trading about $350 higher than that level. So it was a big breakout. I'll talk a bit more about the different ways of trading this, and we'll come back onto the platform and look at some real examples in detail and see what we would have done. So put simply, a breakout up, we've got a level, the market keeps hitting, it can't break through, and then bang, it does. And it can be a suggestion that perhaps a new trend is going to start. The same is true where we have a level below the market support that breaks. It can be a short selling opportunity. But how do you trade these? I'm going to go through some strategy in a second on the platform, but you can trade immediately. So if the market has a level at 5,000, if it breaks 5,000, then you're in the trade. Other people will want to be a bit more patient. They may have a time filter. So they see the market break out through the level, but to confirm or to try and confirm it's valid, they want to see the market hold above the level for an hour, 2 days, a week, whatever, but some sort of filter to try and confirm it's a valid break. Markets don't move in straight lines up or down. So another way of trading breakouts, we get the level that breaks either up or down if we're short selling, and we wait for the pullback. So if the market's pushed higher, we wait for the market to sell off and then jump on board then. We've seen the breakout suggesting prices are going to start a new, stronger trend, but we wait for a slight move against the breakout before jumping on board. We'll see a couple of these examples in a second. The other alternative is to do nothing. We don't need to be in the market all the time, but I do think breakouts can be a great signal that something is changing when it comes to market sentiment, either to the positive or the negative. You do, of course, get false breakouts. No strategy works all the time. So as usual, risk management is still important. If we're trading breakouts, we still need to have some sort of stop on the trade to get us out for minimal loss if it turns out to be a false break. And because breakouts can often mean increased volatility, sometimes those stops will need to be a bit wider than usual. But let's take a look at lots of real world examples, all sorts of time frames, all sorts of different markets. So let's talk about some of the techniques here. Well, let's go back to this gold chart that I introduced right at the beginning of the video. So we know around about 1380 is the level, is the barrier for gold. So with the market just here trading at 1357 in late May, early June 2019, one technique, if we were going to trade it immediately, is to put an order to buy just above that level. So if the level gets broken, then buy. So for example, if the level's 1380, perhaps 1385, 1390, somewhere above that level is where our order goes in. So it's a very simplistic way of trading the breakout. As soon as it breaks, bang, we're going to get on the trade. If we jump forwards in time, so the level breaks, we'd have bought in over the next couple of weeks or so. The market didn't do much, just really sort of chopped around. Actually, for the best part of 6 weeks, the market chopped around and then eventually started moving higher. But here's an example as well where a time filter could have worked. So if the market breaks through a level, if we want to see it hold 1 day, 2 day, 5 days above the breakout point, a time filter would have been valuable here as well, or would have worked here as well. What wouldn't have worked was for waiting for a pullback after the breakout. So waiting for the market to break out, then pull back, then move higher. So we would have, if we'd have waited for a pullback there, we wouldn't have got in on that trade. There are always plus and minuses with these. Let's take a look at another example. Here's a really short-term example from the Dow Jones, the US index, just to show that this can work in all time frames, but doesn't necessarily work all the time. So here's April the 13th. So the Dow trades up to around 23,700, then sells off really sharply for the rest of the session, driving down to 23,075. So drops 600-700 points. So this level here, if we were watching the next day for a breakout, we may be watching that high from a previous day. It was a long way away, but it is only the high from the previous day. And this, I suppose, is where I think, again, both approaches may have worked. So we may want to be a buyer if 23,700 breaks and we're buying straight away on the breakout. But if we waited a bit, actually until the next day, we got a sell-off back below the breakout point. The market held. What's interesting, I think, here from a risk management point of view, is that the market does hold above that previous low just before the breakout. So our risk, if we were buying on a pullback here, it would have been a good opportunity to have a relatively low risk and potential high reward. But there's an example of a short-term breakout. It's not the cleanest of breakouts. The market doesn't take off straight away. But that's the real world. You know, just because a level's broken doesn't mean that suddenly the market's going to be off to the races. But here's an example where a bit of patience would have given us a slightly better entry point, and the market did go on eventually to move a few hundred points higher following the breakout. Here's an example for Apple, tech giant from 2019. So May, the price trades as high as $215 a share, sells off to 170, comes back up to, and in August it breaks through. Now, if you were trading this purely on the breakout, you'd be in straight away on that move through 215. But you can see the market did sell off fairly sharply after the breakout. Let's just step things out a bit. So here's an example where waiting for some sort of pullback after the breakout, the more patient approach, can clearly give us a better entry opportunity and have a more sensible place for the stop. You know, if we see Apple trading down around 200 after the breakout, we have previous support coming in at 190. We can set our stop loss the other side of that. So that's where sitting on our hands would have paid off. Of course, the risk is that if Apple did take off after that breakout, we'd have missed it. But here, some sort of waiting for a pullback and jumping on would have worked. Let's just zoom things out again. And then, of course, the price just carried on higher from that breakout point. So you'd eventually have been rewarded if you just bought the breakout anyway, but a better entry point if you're waiting for the pullback. And of course, breakouts work in both directions. If you're looking to sell short, selling the break below a previous major level can be a good opportunity as well. Here's the NASDAQ. This is a 1 hour chart of the NASDAQ 100 index. These were the lows at the end of February 2020, coming in around about 8,100. The market had a massive bounce back, 10% bounce back into early March. But then we can see by the second week of March, we're starting to probe below that level. So again, on the break here, below 81.20, we might be looking to sell short and see what happened next. So the market does break lower, broke about 300 points lower. But if you missed that, the market did rally back up towards the breakout point and actually through it. So again, if you're waiting for a second bite of the cherry or some sort of confirmation, there was an opportunity to get short at a better level with perhaps stops up above these old highs just before the breakout. And after quite a bit of chopping around, the market did eventually sell off, trading as low as about 6,600. So I'm just using this to illustrate that we have breakouts in both directions and all sorts of time frames. But what we need is a previous major high for the time frame we're looking at, or a previous major low. And of course, you get false breaks. Let's have a quick look at one of those. The price of gold is an interesting one because at the time of recording, it's breaking out again. It's just broken out to 7-year plus highs. We'll see how that one turns out. But it did break out also in early March 2020, broke through the previous high, but then reversed. I mean, this was clearly the time of coronavirus, so markets had incredible volatility. But, you know, a good example here. of a breakout that didn't work. The price dumped, $250 before eventually turning around and moving out to fresh highs once more. So it's important. It shows why it's important to have some sort of risk management in place. Stop losses are still important, and not to blindly assume that breakouts are just going to work every time. But I think there are filters you can put in place, whether you wait for a couple of days or you wait for a pullback, and definitely logical areas to place stop losses that can help you when it comes to trading these sort of breakouts. That's it for this quick strategy video on trading breakouts. If you have any questions or comments, leave them in the comments down below. But from me, David Jones and Capital.com, we'll leave things there. Good luck with your trading.